This is something that I think is more prevalent out there in the marketplace than folks realize. There's a lot of media out there about how the baby boomers have, bought up all the homes and they're sitting back, enjoying their homes and their large amount of equity and their very low mortgage rates. And so therefore they're financially secure, and they've sort of taken the fun away from the younger generations, the millennials and the Gen X's and so forth. Well, not entirely. Guess what? There are some baby boomer homeowners out there who are in situations right now where they do have some struggles, in particular as it relates to tapping the equity in those homes that they do happen to own, where there is a lot of equity. But guess what? Some of those baby boomers are having a real hard time tapping into it. So I want to go over that here with this next couple of slides and give you a real life example. It's actually a situation that I'm dealing with right now. And I put on the slide here, some baby boomer homeowners face a challenge at accessing record equity. That is definitely true. And I'm going to give you a perfect example right here, a case study. So here's the challenge. The homeowner is over 55, purchased a condo about 7 years ago, 2017. It's currently valued or estimated at value of $450,000. And the homeowner has an FHA loan on it. It was an FHA approved condo. And there's an FHA loan on this property. The balance is only $111,000, and the mortgage rate is 2 7/8. Very low, right? We hear this all the time. But here's the rest of the story of the homeowner. Due to a reduction in employment income during the pandemic, the homeowner obtained a loan modification in 2021. That resulted in a $31,000 HUD junior lien for the modification cost, which, by the way, there's a good example of those loan modifications where the lender might help you and modify your loan, extend out your loan terms, and maybe lower your interest rate. That's usually not for free. You do end up having to pay for that at some point. This is a good example. This homeowner got a loan mod, got the mortgage loan extended out on term, got the rate lowered because in 17, when the loan was first obtained, the rate on that loan was 3 3/8. When it was modified, it was dropped to 2 7/8. But there was a cost, $31,000. The lender simply recorded a junior lien in favor of HUD as part of the loan modification process. So that is a lien that this homeowner would have to deal with in trying to tap into the equity. The homeowner did inquire with us about a HELOC to do some home improvement, in particular to replace air conditioning as well as doors and windows. Here's where we ran into a problem. Credit score, as I just talked about. Qualifying credit score is under 630. That is too low for just about any HELOC program out there, particularly the ones that we have available. Under 630, too low. You have to have a minimum of 640. Most HELOC programs even higher, 660, 680, even some are at 700. And even a HE loan, a fixed rate second, the credit score of the homeowner was too low to be eligible. And then the other thing to keep in mind in this scenario is the borrower's current employment situation, the current income for this borrower from the borrower's job is about 35% lower than it was in 2017 when the home was purchased. So that created a problem because we even looked at maybe doing a first mortgage cash out refinance. I know that sounds crazy when you've got a 2 7/8 first mortgage. But in some cases, when the loan amount, $111,000 is so low relative to the amount of the HELOC a borrower, a homeowner wants to request, in this case, they were looking at maybe somewhere in the 75 to 100 range. Sometimes that does make sense to just refinance the first mortgage into a new one, even though the rate's higher, get the cash out that way because the blended rate calculation might call for that to be as good of an option. However, again, with that 35% drop in income compared to what the homeowner was earning when they bought the house in 2017, even a first mortgage refi didn't pencil out. Debt ratio is too high. Can't get enough money out to cover that junior HUD lien and then still have the cash out proceeds to do the home improvement. So with that, it looked like our options were kind of limited. In fact, really, we were thinking there was no other options, but we do have a solution. So let's go to the next slide and I'll show you what the solution is. In this case, the solution that we're presenting to this homeowner is a product called a Home Safe Second. Now, what this is, it's a second mortgage. It's a junior lien. It's basically a reverse mortgage type of a second mortgage. It behaves in a very similar fashion as a HECM, home equity conversion mortgage, reverse mortgage. A home safe second is a fixed rate loan. It's a closed-end second, so it's not a line of credit. It's not a HELOC. It is a fixed rate, traditional fixed rate loan. But you don't make any monthly payments on the loan. They're not required. Now, notice it says not required. That's an important bit of language there, because what that means is if you want to make payments on this home safe second, you can, but it's not required. And if you don't make those payments, what happens is the interest due on the loan simply accrues back to the balance. So the loan will grow over time. In getting a home safe second, there's no change to the rate on your existing first mortgage. And in fact, for this program, you have to have an existing first mortgage and you have to continue to make payments on that mortgage. So that doesn't change. That first mortgage stays in place. You still have to make payments on it. So the home safe second is going to go behind that first as a junior lien. Now, in this case, the home safe second will pay off that $31,000 HUD lien from the loan modification done in 2021, but there was enough money left over in the proposal for the borrower to get the additional funds that they needed to do those home improvements we mentioned earlier. Now, in getting a home safe second, just like when you get a HECM home equity conversion mortgage, first mortgage, reverse mortgage, there's a mouthful, you are still responsible for property-related expenses. So you still have to pay your first mortgage, you still have to pay your taxes, your insurance, your HOA dues if those are applicable. So all that remains. You still have to make those payments. With this program, the minimum credit score is only 600. So with this borrower who was under 630, eligibility is not a problem. Their credit score is sufficient. They're going to be fine in eligibility as to credit score. The other thing about this program, debt to income ratios are not calculated. So even though this homeowner's income is 35% lower than it was when the home was purchased, there's no debt to income ratio calculated. So that won't be a reason that this homeowner would be declined because of some sort of debt ratio being exceeded. Now, you do have to meet a minimum residual income requirement. And in this case, it appears the homeowner, who is a single person, no dependents, no children, the residual income requirement is a little over $500 a month based on a family household of one person. So that's pretty achievable in this scenario. And then the other thing about this is it's a non-recourse loan, just like a reverse mortgage, just like a HECM, home equity conversion mortgage, reverse mortgage. Those are non-recourse loans. What does that mean? That means when at future years, if the home value has dropped to the point where the existing mortgage balance, including this home safe second, is above what the current market value is, the homeowner will not be responsible for the deficiency balance. So if they find themselves at a point where they're going to be selling the home or vacating the home and have to sell it, and if the current mortgage balance, the first mortgage plus the home safe second balance, if they exceed the value of the home when it's being sold, the homeowner will not be responsible for that deficiency balance. So that's a very, very good feature. So this is turning out to be a great solution for this particular scenario. And there's a lot of these kind of homeowners out there. They're caught in this sort of no man's land where they're over 55, but they're not 62. So the typical HECM reverse mortgage, not an option yet because they're too young to meet the minimum eligibility age of 62. And yet they own a home. They may have owned it for many years. They're nearing retirement. Maybe they've had a reduction in income. They had to do a job change. So they're not making as much as they were, but they own the home. They've got a lot of equity. They have a low rate first mortgage that they are able to comfortably pay on, but they've got a bunch of equity. They're having trouble accessing that because they don't qualify based on the other criteria that's required for a first mortgage cash out, for a HELOC, a home equity loan, a HE loan. So you can really get trapped in this kind of situation. This homeowner was extremely frustrated at the inability to get qualified for anything, to tap into all this equity that this property provides to the homeowner. Home Safe Second solves that problem. So I just wanted to go over this and let you know this is a great program that you can consider if you're over 55, not yet 62, where you can take a look at that reverse mortgage option, that first mortgage, reverse mortgage option, this is another basically equity loan option for that over 55 homeowner with a lot of equity, but having trouble qualifying for the other conforming programs that are out there. So if you'd like more information on this program, feel free to get in contact with me. I'd be happy to show you some numbers. We can put together a proposal for you very quickly, and then be happy to discuss the details with you. So hopefully if you or anyone you know out there in that situation, don't hesitate to call us. We'd be happy to get you started on getting into that equity as quickly as possible.